In US dollar terms, incomes may have nominally risen over time, but in gold terms, we're getting poorer and poorer as time proceeds. Meanwhile, the largest gold buyers in the world, on net, continue selling fiat US dollars for gold. And more now, the mainstream financial media are reporting this fact.
The custodians of trillions of dollars of global central bank reserves are eyeing a move away from the greenback, with gold, the euro and China's yuan all in favour. It comes as the splintering of world trade and geopolitical upheaval has sparked a rethink of financial flows. A report by the official Monetary and Financial Institutions Forum is due to be published later on Tuesday. It says 1 in 3 central banks managing a combined $5 trillion plan to increase exposure to gold over the next 2 years. The survey of 75 central banks was carried out between March and May and gives a first snapshot of the repercussions of Donald Trump's tariffs. Gold, which central banks have already been adding at a record pace, is expected to benefit further, with around 40% of central banks planning to increase gold holdings over the next decade. The US dollar, the most popular currency in last year's survey, fell to 7th place this year. 70% of those surveyed said the US political environment was discouraging them. In currencies, the euro and yuan stand to benefit the most from the diversification. Around 16% of central banks surveyed by OMFIF said they plan to increase euro holdings over the next 2 years. That makes it the most in-demand currency, up from 7% a year ago, followed by the yuan. The survey respondents expected the euro to reach about a 22% share of global reserves in 10 years' time, but Europe could attract a higher share of reserves sooner. Sources speaking to reserve managers say that's if the bloc is able to boost its pile of bonds that are currently dwarfed by the $29 trillion US Treasury market.
The Central Bank of Poland, which now has 22.4% allocation to gold bullion reserves, stated this week that, quote, despite the fact that gold does not pay interest or dividends, unlike shares or bonds, in the long term that covers wars, crises, and disasters, gold's provided a real return that was close to 3% above U.S. government treasuries. Now, the Bank of America points out that it is the explosively large and growing U.S. debt and deficits, and I would argue as well unfunded liability piles in the future, that are going to drive gold long term, not wars. In terms of the U.S. gold audit that is likely never coming in our lifetimes, the green section of foreign gold reserves currently reportedly held by the Fiat Federal Reserve onshore in the United States, well, nations offshore, like Germany and Italy, are now having internal political calls to reshore that gold. Good luck. Meanwhile, the Chinese Shanghai Gold Exchange made headlines this week as they announced opening their first off-mainland China gold vault trading and settlement operation now in Hong Kong, with physically delivered gold contracts fully denominated in Chinese yuan. One of the reported reasonings in mainstream financial media is China wants to have a greater influence in gold's day-to-day pricing, as, of course, they are the largest consumer and miner of gold in the world. And they also have aims to further internationalize the Chinese yuan in international trade. Indian financial media had the following coverage this week on these headlines.
Our next story is about gold. China has opened up a gold storage vault in Hong Kong. This is a first. But why is this significant? And why should it matter? At least to you. Let me explain. China has a massive gold exchange. It is called the Shanghai Gold Exchange. It is just like a stock market exchange. But instead of stocks, it is used to trade gold. This exchange is the only official platform to trade gold in China. It is controlled by the People's Bank of China. That's the Central Bank of China. Before today, this exchange only operated in mainland China. But now it is expanding outside by setting up a bullion vault in Hong Kong. Along with that, China has also launched new gold contracts. These are financial agreements. They allow buyers and sellers to trade gold at specific terms and conditions. So the goal of this expansion is to facilitate gold trades. But here is what's significant. These trades will happen in the Chinese currency. the yuan. Trades can be settled both by cash and physical delivery of gold. This may seem like simple trading, a convenient option for those buying gold in yuan. But China's moves also serve strategic purposes. It can challenge the US dollar. Most of the gold trading today happens in the greenback, with a large number of trades being routed through either New York or London. But China is now offering an alternative by opening a facility outside the mainland and by allowing more gold trade with the yuan. This also promotes the Chinese currency and de-dollarization. Now, de-dollarization means moving away from the US dollar for global trade. In the past, whenever de-dollarization was pitched as an idea, the first instinct is usually to look at other currencies, options like the euro or the yuan. But gold is emerging as a stronger alternative now. Central banks around the world are buying more gold. They are increasing their gold reserves. Central banks own over 35,000 metric tons of gold now. That's about a fifth of all the gold ever mined. Central banks are also under pressure to repatriate their own gold from other countries. Germany and Italy are facing these calls. They have the second and the third largest gold reserves in the world. Some of it is currently stored in the United States, and its combined value is around $245 billion. There is pressure to bring back this gold now. What's the reason behind this demand? The erratic policies of the Trump administration. Trump's growing attacks on the United States Fed, the Central Bank of America, and the increasing geopolitical turbulence. America itself has the world's largest gold reserve. Now other central banks are stocking up. Recently, 75 central banks participated in a survey. They were asked a simple question: will they increase their holdings in gold? 40% of them said yes. They plan to increase their gold reserves over the next decade. So whether it's China or Western nations, gold is gaining ground. A new de-dollarization trend is taking shape, and this time it's being driven by gold.
At the moment, the correlation between gold and silver is at a 2-decade low level, according to the CME Group. Well, that's not stopped silver from performing well this first half of 2025, beginning the year priced below $30 an ounce spot. On the other side of this break, we're going to look at mainstream financial media coverage this week on the fundamental drivers for the two main white precious metals, silver and platinum. We're also going to hear analysis on why gold and silver likely have more upside to come in the second half of this year, 2025. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates. And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
What's better than an ounce of free silver? How about 500? Get ready for another monster-sized giveaway with the SD Bullion Monster Box Sweepstakes, featuring 500 of SD Bullion's very own Silver Tree of Life coins in a monster box. This highly detailed piece of silver is a beautiful addition to any collection, and it features a hidden inscription on one of the tree branches that changes every year. So don't miss out on this exciting silver giveaway from SD Bullion, because someone has to win it, and it might just be you. Click the link below for your chance to win.
The spot silver and gold markets sold lower on the week, with the spot silver price likely to close just over $36 an ounce bid and the spot gold price to finish the week around $3,280 an ounce bid. The spot gold-silver ratio lowered this week, finishing at 90 with silver's relative strength recently over gold. The spot platinum market continues climbing, albeit with high price volatility, mostly to the upside. Now up over 50% on the year, platinum, along with silver, they are both getting more mainstream financial coverage on their bullish fundamental supply-demand situations.
Both silver and platinum have surged in recent weeks, with silver reaching a 13-year high above $36 per ounce and platinum climbing to levels last seen in 2021. This bullish momentum is primarily driven by robust industrial demand, especially for silver in the manufacturing of solar panels and platinum in hybrid vehicle production, alongside persistent supply deficits. Silver's supply lagged demand by about 15% in 2024, with another shortfall expected this year. Meanwhile, platinum faces its third consecutive year of supply deficit, exacerbated by reducing mining output in South Africa and surging Chinese demand. Historically, silver and platinum have shown some positive correlation during precious metals bull markets, but their dynamics can diverge due to differing industrial applications. Recently, both metals have experienced a simultaneous rally, suggesting an improving positive correlation as investors seek alternatives to gold amid high prices and macroeconomic uncertainty.
To finish this week, we hear from TD Securities analyst Daniel Gali, speaking this week on why he believes both gold and silver are headed higher in the second half this year, 2025.
Okay, what about gold? Should gold have moved more than it did during this conflict? Typically, would commodities markets expect a move in gold more so than it did during this conflict?
I think it traded very consistently with how it typically trades in terms of geopolitical risk premia. The thing about gold right now is that I think most of the West is actually, there's this perception that gold is a crowded trade, that it's overowned. We actually think gold appears to be technically overbought, but it's actually underowned. And so in that case, thinking about it in terms of how it's traded over the course of the last week, you really kind of miss the big picture here, which is that the US dollar is partly losing its store of value. Gold is benefiting from that. And the outlook for gold from here is exceptionally strong.
Explain underowned. Overbought, but underowned. Explain that.
So I guess when you look at the chart, right, gold's had an exceptional year in 2024. It's had an exceptional start to this year as well. People think that because of that, then it must be a very crowded trade. But the reality, if you get really granular about the positioning data, you find out that macro funds are actually at very least flat in gold, meaning they don't hold any. If anything, they might have added some shorts in the last week or so. You find that ETF inflows have been significant. Retail participation in those ETFs is probably at a decade high, but the overwhelming majority of those inflows are a function of a change in strategic asset allocation from institutional investors, which means they're not going to turn around and sell that within the course of a week. So who really has a lot of gold to sell? It's not really clear to me, which tells you, selling exhaustion appears imminent to us, and participation in gold is so low that I have a hard time seeing how we'll trade significantly lower.
You think gold prices will move higher?
We do.
Because they've plateaued now for several months. They've been bumping around 3,400 for a while now. You think at some point there's going to be a sustainable breakout up?
Yeah. But I mean, here's the way we look at it, right? The East fears currency depreciation. That's what drives them to buy gold. The West fears recession and stagflation. That's what drives them to buy gold. The detente on trade has eased both those fears, and in turn, the buying impulse that drove gold prices higher earlier this year has faded. But participation at this moment in time is so low that it's really just hard to see who has more to sell. And you have so many catalysts on the horizon, even as of end of June and onwards, on tariffs, on Fed credibility, on Fed interest rate outlook, and so on, that it's hard to see how participation in gold is not going to rise from current levels.
When I spoke to you earlier this year, you were very, very bullish on silver, and we have seen silver prices rise. They're at more than $36 per ounce right now. Do you see more coming in silver? I think you said that $40 silver was possible this year.
Yeah, we do. Right at the beginning of this year, our silver squeeze you can buy into thesis was premised on this idea that the fear of tariffs was going to drain so much inventory out of London that it was going to challenge the market structure. That has occurred, except on Liberation Day, bullion was exempt. So theoretically, all the surplus metal that moved into the U.S. For fear of tariffs can now move back to London. The issue now is that it's not. It can, but it's not. So why isn't it? Why aren't markets incentivizing that to happen? And we actually think that this is evidence that the financialization of silver as a real asset is prohibiting that reverse arbitrage from occurring. And what that implies is that the only way for London inventories to replenish is through higher silver prices.
That's going to be all for our weekly SD Bullion Market update. As always, to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.